Analyzing the possibility of a reverse housing market crash involves considering various economic indicators, demographic trends, and external factors. Historically, housing markets have experienced fluctuations influenced by factors such as interest rates, economic conditions, and housing supply and demand. One potential concern is the impact of rising interest rates on the housing market. As interest rates increase, the cost of borrowing rises, potentially leading to decreased demand for homes. This could result in a slowdown in the housing market, affecting both homebuyers and sellers. Central banks often adjust interest rates based on economic conditions, and monitoring these changes is crucial for understanding potential risks to the housing market. Economic conditions play a significant role in the stability of the housing market. Job growth, wage levels, and overall economic health can influence individuals' ability to purchase homes. Economic downturns may lead to job losses and decreased consumer confidence, impacting the real estate sector. Demographic trends are another factor to consider. Changes in population size, age distribution, and migration patterns can affect housing demand. For example, a sudden decline in population growth or a shift in preferences for urban or rural living could influence housing market dynamics. Supply and demand dynamics within the housing market are essential considerations. If there's an oversupply of homes relative to demand, it could lead to a decline in property values. Additionally, regional variations can impact the housing market differently, with some areas experiencing more significant fluctuations than others. External factors such as government policies, regulatory changes, and global economic conditions also contribute to the overall stability of the housing market. For instance, alterations in mortgage regulations or tax policies can influence housing affordability and impact market activity. The role of speculative behavior in the housing market is worth examining. If there's excessive speculation and unsustainable price growth, it may lead to a housing bubble that could eventually burst. Monitoring price-to-income ratios and price-to-rent ratios can provide insights into whether the housing market is becoming overvalued. Technological advancements and societal changes can influence housing preferences and the real estate market. The COVID-19 pandemic, for example, accelerated remote work trends, potentially impacting housing demand in urban areas. While these factors shed light on potential risks, it's important to note that predicting market movements with certainty is challenging. Real estate markets are influenced by a complex interplay of factors, and unexpected events can significantly impact outcomes. Investors, policymakers, and individuals involved in the housing market should stay informed about economic indicators, demographic trends, and regulatory changes to make informed decisions in an ever-changing landscape. Click like and subscribe